Hello, everybody. My name is Abdul Hakim bin Azhar, and we have here,
My name is Muhammad Nur Aiman bin Omran.
and we have,
And my name is Ainanisa.
and of course, we have Farida here as our group member. Okay, today we are going to talk about IS-19, which is about employee benefits. Now, when you walk into an interviewer looking for a job, the interviewer will ask you, why do you want to work here? Well, obviously because of the money. I need the money to survive. I need the salary. But you should look further into it. You should ask, I noticed that your company has a good defined contribution plan. It has a good post-employment benefits, termination benefits. So that's why I want to work here. So it is important for us as an accountant to know how do we account for termination benefits, post-employment benefits, long-term benefits, and short-term benefits. So we are now going to Iman's part to talk about short-term employee benefits. And Mr. Aiman.
Hi everyone who watching this video. So today my part is going to talk about the IAS 19 employee benefits for the introductions. It is actually a standard that stated about the employee benefit that specify the guidelines to recognize and to present the different kinds of benefit to the employee itself. So the IAS 19 is actually categorized into two accounting principle, which is fall under liability and expenses. The liability itself means return for prospective employment payments after an employee has delivered a service. So the next one is about the expenses, in which that where individual consume the economic value from the employee services, return of the compensation for its employee. So um, when the company needs to pay some amount to to his respective employees, they incur expenses, and the liability itself happen um, when the employee actually when the company owe the employee to be paid the amount of the benefit itself, such as wages, maybe in terms of bonus and many more. Next is I found is that the matching principle is actually complement each other within the employee and the employer. So it is basically like 95% of it. And so the company actually need to recognize the liability for the employee services for employee benefits to be paid in the future, meanwhile the expenses happen when the result of employee are consumed. So the matching principle here means that they requires the revenue and also the any other related expenses um to be remeasured together in the same reporting period itself. So that is where we can call it as matching principle. Okay, next. So there are four categories of the employee benefits under IAS 19. For the first one about the short-term employee benefit, and the second one is about the post-employment benefits. Third one is about the other long-term employee benefits, and fourth one is about the terminations benefits. So I'm going to talk about the short-term employee benefits. Let's go. So what is actually short-term employee benefits? When we heard about the short term means what? It is like not exceeding 12 months of the day of our calendar year of the accounting period. So it is actually more to the benefits that received by the employee within the 12 months, and it's actually categorized into two benefits, either monetary and non-monetary. Monetary benefits more to wages, salaries, paid annual leave, paid sick leave, and also bonuses. And the second one is about non-monetary benefits, more to the medical care, housing, and cars. Um, in other examples also, we can it is other example also that I can share to you is about the employee bonuses, in which that under a bonus plan, an employee earns like maybe 10,000 ringgit bonus based on the measure aspect of the of her or he or her or his performance within a year. So the bonus is paid like the following year, and we as accountant actually need to record the bonus expenses within the year when the employee is earned it. So yeah, that's one of the example of it. Next is the fun fact about it is about um sorry again the self-employed. When there is a self-employed, they actually not um enjoy these short-term employee benefits because they actually work as a freelancers and agents that actually no obligations in terms of this short-term employee benefit. Okay, next. Okay, next let's go into the example 4.1 given salaries and wages. So the question is about assuming an employee earns a wage of 2,000 a month, that the rate of the EPF contribution is 11% for the employee shares and 30% is for the employer's share. So the solution we need to take a look, we need to take into account is under we need to go through the Sochi, then the entity charges the contribution payable 260, in which that this is more to the employer, and whereas the contributors paid by the employee of 220 in which that need to subscribe it in which need to be implement 11% will be part of the wages and salary cost. So when they paid means the company paid, it will reduce the cash. So the total EPF here means that by the employee 220 plus with 260 by employer, they combine it integrate together is 480. So let's assume that this company paid wages on 28th every month, and EPF and either EPF is actually the obligations by the employer to the employee. So the company need to pay the EPF uh, every month. So let's say on the 28th of May 2001, the company need to actually spend um, the remuneration and the wages for his employee, which is here in this case 2,000, and they need to actually credit the accrued expenses 220 in which that they need to comply with the 11% from the employee share, because they actually incurred liability from the company perspective, and the credit one they need to the balance itself we need to credit in terms of bank for the company. So on the end of the month, like 31st of May 2021, the debit itself, it is more to the employer itself. They need to pay the EPF to his respective employee, in which that they need to debit EPF 260, which is equivalent to 30% of the employee shares, and they need to credit the accrual expenses 260. So in the following month, the company actually need to pay the KWSP to his employee, and then the company actually need to debit the accrual, because it is actually a liability to the company itself, and the credit one is the bank due to the company use their bank account to reduce his cash and bank, right? Okay, next slide is 4.2 and 4.3. 4.2 is stated about the paid annual leave. Okay, 4.2 is more talk about a car manufacturer paid wages and salaries. for 500,000 ringgit in the year of 31st December 2015, and there were 80 days of annual leave that were not taken into this period. So the financial call of this estimated to be 30,000 ringgit, and the general entry here, the general entries here is debit wages, expenses, credit bank and accrued expenses. So why we need to credit bank and accrued expenses? In total is 530, right? So the total itself 530 is actually more to liability to the company itself. The company actually need to pay this car manufacturer 530,000 ringgit, and that's why they actually need, that's why they actually credit this transaction. Correct, correct, Kim? Yeah. And next is 4.3. 4.3 is more to profit sharing and bonus. So profit sharing is this example is actually two different things. Profit sharing means that in terms of revenue, the revenue collected by the company itself, and the bonuses actually more to performance from his respective employees itself. So the question here means the question here stated a profit sharing plan requires the entity to pay specified proportion of its profit for the year to employees to serve throughout the year. So if no employees have to leave during the year, the total profit sharing payment for the year will be 3% of the profit. The entity report the profit is 500,000. Okay. So the solution is that we need to recognize the liability and expense 15,000 ringgit, in which that we need to use the profit collected by the company, need to times with the 3% of the profit sharing payments to his employees itself. So it is actually liability and expense to the company. Next. Next, I will pass to the Hakim.
Okay, thank you, Aiman. Now we are going to see the long-term benefits for the long run on why you stay in that company. So there's certain benefits that you get when you work in an organization. You can get long service leave, sabbatical leave, and a jubilee. So let's go through this one by one. See, long service leave, aka as LSL, is you work for a number of years, you will get LSL with pay, cuti bergaji. Let's say you've earned that one lah, like you work there for 5 years, and then they finally give you LSL. You can take a break for like 2 months, and you will still get paid of your salary for that 2 months of break. Long service leave, which is a good thing, and must strive to find this long service leave in the company. You can go vacation, you can take a break for 2 months, and no need to worry about financial troubles because the company will be paying you while you are at home, while you are not working. Next, sabbatical leave. See, sabbatical leave is a period in which a person does not report to their job but is still employed by their company in order to pursue personal interests. Example, study leave. See, I'm working for a company and I want to further my studies. I want to do masters. So I asked my employer for a sabbatical leave. And depending on the company, if they're in a good performance, they will probably pay you while you go on leave, or they won't. But you still get the sabbatical leave. Um, that is about the sabbatical leave. Next is the jubilee. Jubilee, um, every 5 or 10 years, you'll get, for example, every 5 or 10 years, you will get a bonus, and a bonus in the form of you can earn gold 10 gram. You can maybe you get a bonus for like 2 months. It depends on how long you've worked there. Jubilee means celebration of a date, usually 5th, 10th, 15th, 20th anniversary there. They will celebrate and give you a bonus. Long-term benefits, it's important to note that it is payable after 12 months from the end of year in which employee has provided the service are termed as post-employment benefits. Okay, next we move on to post-employment benefits. the third main topic and the longest one in this chapter. So post-employee benefit is what happens when you work in a company and then you retire. What is it? It is a post-employee employee benefits other than termination benefits. Fayatu will explain that later, which are payable after the completion of employment. Completion of employment means you've worked there for a number of years and then you finally retired. So that the example is various pensions, retirement benefits, post-employment life insurance, and post-employment medical care. There's two types of it. It's first defined contribution plan, which is synonymous with KWSP and EPF, and defined benefit plans, which is a bit hard to find in Malaysia and a bit complex. Now this we'll go into detail about defined contribution plans first. Example is the EPF. The employee will take some of his salary, usually 11%, and pays them to EPF. So when you are retired, EPF will give back the money to you. This is the definition. The entity pays fixed contribution into a separate entity and will have no legal or constructive obligation to pay further. That means if that employer has to pay KWSP 13% and they only have to pay 30%, nothing more, nothing less. So they just have to pay for that rule. There is no risk among the employer. The risk is borne by the entity that is EPF. But this one is very simple. I might explain it just a bit now. So debit expense for employee benefits, credit accrued expense if you paid it a month later, you want to pay a month later, or you pay it by cash. This is the accounting treatment. Very simple, very easy, very common in Malaysia. Don't have to worry about this. While this one, defined benefit plans, is a very complex because it involves an actuary. An actuary will give the numbers so that the right accounting treatment can be done. Okay. Example is Google's death benefit. You see, it's not even Google's death benefit. Malaysia don't have something like this. It's very rare. Only something like Google can think of this. Okay. So the employer has the obligation to pay specified amount of benefits according to the plan to the employee. Okay. And all investment and actual risk does fall on the entity. The entity means the employee. They have to bear the risk. See, they take 11%, for example, they take 11% of money from the employee, and they promise, they made the obligation to the employee to pay it on when they retire. So they have to keep their word. They have to invest on asset, and they have to give it back when the time comes. Risk falls on the entity. Now, as I said before, it was very complex to account for the defined contribution plan. There's 4 steps and plenty of items to take care of. Me, Aina, will explain about all of this in a while. But first, let's look at the step 1 first. Step 1 is to determine the deficit or surplus. How do we do this? Is to use the projected unit credit method. We discount the benefit, deduct the fair value of any plan asset, and we'll get our answer, surplus or deficit. Next, step 2, determine amount in the statement of financial position. We want to know, are we going to have a asset ceiling test? And we want to know, is it an asset or a liability? And we want to determine amount, of course. And the third step is to determine amount in the profit or loss. Profit or loss in this always refer to the expenses of the current cost, past service cost. Is there any gain or loss on settlement? Net interest on the net defined benefit liability. And lastly, step 4, determine the remeasurement in other comprehensive income, like actual gain or loss. Okay, let's move on to the this item first. Past service cost. This is the easiest one as it is an expense. Okay, it arises because of an improvement to the pension scheme, a curtailment, recognized as an expense at the earlier of when the plan amendment occurs or when the entity recognizes related restructuring costs or termination benefits. Don't worry about curtailment, all of that. Fariatu will explain that later. Now you look at example 4.7. The pension plan is the employee with more than 5 years service at 1 January 2016 is 320,000 for the more than 5 years. For those who's less than 5 years, the employee's service, they will get 150,000. So past service cost requires to take total past service cost of 470,000 to be recognized immediately in the statement of comprehensive income. So you just add up, get the total, and debit profit and loss 470,000, credit defined benefit obligation. So you just total it up and take the total amount and debit credit. The 2 more years until vesting doesn't matter because it happens in the past. So that's it. Just take the total and recognize it immediately in the comprehensive income. Next, we'll go to the asset ceiling test. As I mentioned in step 2, Aina will present about this one. So Aina, if you will.
Okay, hi. So this is the step 2, as Hakim mentioned before, asset ceiling test. So definitions of asset ceiling test is the present value of any economic benefit available in the form of scheme refunds of future payment reduction to define the benefit plan. It consists of two. First, net defined benefit liability. Any deficit or surplus adjusted for any effect of limiting a net defined benefit asset to the asset ceiling. Second, net interest of the net defined benefit liability. The change during the period in the net defined benefit liability that arise from the passage of time. So assets according to IAS 19, asset ceiling available in the form of refund from the plan or reduction in future contribution to the plan. Next, when the asset ceiling is lower than the surplus of the plan asset over the defined benefit obligation, the asset ceiling will be recognized as the defined benefit asset in the statement of financial position, and thus the write down amount is effect of asset ceiling. A portion of the effect of the asset ceiling will be recognized in profit or loss, and the remaining amount will be recognized in other comprehensive income. Okay, next. Here the example of asset ceiling test. Okay, an oil and gas entity has this balance relating to the defined benefit plan. Present value of the obligation, we have 34 million. Fair value of plan asset, 39 million. The present value of available future refunds and reduction in future contribution is 2 million. So first step is to determine the surplus of deficit. We need to minus present value and plan asset. So we get 5 million, which is surplus. Okay. Step 2, we need to compare. We need to compare surplus and the available future refund and reduction in future. So the plan asset 3 million. So 3 million 3 million is a remaining amount that will recognize in other comprehensive income. So 2 million is the surplus of the plan asset over the defined benefit obligation that will be recognized in statement of financial position. As I mentioned before, the lower if when the asset ceiling is lower than the surplus, so it will be recognized in statement financial position. Next. Okay, next is summary of profit and loss and other comprehensive income. First, current service cost. The accounting entries will be debit profit and loss, credit defined benefit obligation. So the pension cost estimate by the actuary relating to the current reporting period when the when it increase the pension obligation. Okay, next, past service cost. If it lost, we need to debit profit and loss, credit defined benefit obligation. If it gains, we need to debit defined benefit obligation and credit profit and loss. It is because due to the plan amendment and any gain or loss from curtailment. Okay, the last one is net interest that related with net defined benefit liability or asset. Okay, if interest expenses, we need to debit profit and loss, credit defined benefit obligation. If it interest income, we need to debit plan asset and credit profit and loss. Okay, this is to determine by applying the discount rate at the beginning of the reporting period. Okay, next. Okay, next is projected unit credit method. The definitions of project unit credit method is to estimate the ultimate cost to the entity of the benefit that employee has earned in return for their service in the current period. Next is discount that benefit in order to determine the present value of the defined benefit obligation and the current service cost. Okay. Next, to determine the amount to be recognized in profit and loss and other comprehensive income. Here the formula to get to here is the formula. Okay, next. Here an example of pension obligation to use project unit credit method. A director of an entity receive a retirement benefit of 10% on his final salary per annum for his contractual period of 3 years. The director does not contribute to the scheme. His anticipated salary over the 3 years is 200,000, second year 250,000, and last year is 3,000. So it's required to assume a discount rate of 5%. So now we need to calculate the current service cost, the pension liability, and the interest cost of the 3 years. So after we imply the formula to calculate the present value of current service cost. So here the completion of year 1 of services will get 27,211. Next, for year 2, completion of 2 years of services, 28,571. For the last year, completion of 3 years of services is 3,000. Okay. Next step is to get liability at the end. For the year 1, the liability for the year 1, opening balance is 0. For the year 2, opening balance is 20,211. For the year 3, the opening balance is 57,413. Okay. To get liability at the end for year 2, we need to plus the liability opening balance plus interest that we times 5% and plus discounted current service cost. So we will get 57,413 143 for opening balance in year 3. Okay. Same method to get liability for year 3. We need to plus 57,143 plus 2,857 and plus 30,000. Then we will get closing balance for year 3, 90,000. So this will be recognized in profit and loss. We need to debit profit and loss and credit defined benefit obligation. So next, I will pass to Faridatul. Thank you.
Okay, thank you Aina for your explanations. Now I'm going to explain on the curtailments and settlements. So firstly, curtailments occurs when there is a significant numbers of employees who leave the scheme, commonly seen if there is a reorganizations or restructurings of the business or change in scheme from defined benefits to defined contributions. So when we want to know when is the curtailments occur is we need to remember this keyword, which are when there is a reorganizations of the business. Of course, it will cause the redundancy of the employees, meaning that the numbers of the employee will be reduced. And it can also happen when there is a change in scheme where the company is operating a defined benefits and they want to change it to defined contributions. So this happen mainly because your company thinks that defined benefit is more risky and expensive, so they want to downgrade it to defined contribution because it is less risky and more cheaper. Hence, this will result to a decrease in numbers of employees as they need to reduce the cost. So the employees that left the company due to the redundancy are no longer part of the scheme. So that's why the pension liability was decreased because the employee that used to be part of it now are gone. So the payment of the curtailments is usually will be paid in the lump sum cash payment in exchange for the right to receive the specified future benefits. So whenever there is a curtailments, we need to remeasure and reassess back the assets and the liability to the fair value. So if there are any change due to the remeasurement, the amount will be taken as profit or loss on the curtailments, and it needs to be recognized in the profit and loss statement. When it is recognized in the profit and loss statement, it will be treated as a past service cost. So now that we know what is curtailments and what is the accounting treatment for the curtailment, now I'm going to explain more using the example 4.12. So as you can see here in the example, it says that an entity closed down its subsidiary and the employees of the subsidiary will earn no further pensions benefit. A payment of 6 million ringgit was made out of pensions plan asset to employee who left the scheme, and the reductions in the pension scheme liability as a result of the curtailments was 8 million ringgit. So as you can see here, there is a decrease in the pension liability of 8 million ringgit. So the reductions of the pension liability will be treated as a gain. So as you can see here on the slide, the difference of the reductions of pension liability 8 million ringgit and the settlements of the plan asset 6 million ringgit will be treated as the net gain on the curtailment, which is 2 million ringgit. So what we need to do is that we will debit the net pension liability 2 million ringgit and we will credit the net gain on curtailments 2 million ringgit. And this 2 million ringgit, we will recognize the gains on the curtailment in the profit and loss statement, and it will be treated as the past service cost. So if you think like logically, like normally, when this happens, the company, they need to compensate the employees for the redundancy, or they also need to compensate them when they are made to change from the better defined scheme to a worse scheme. So normally, in this type of situations, it will cause the liability to go up as you need to bear the cost to pay for the compensations. But here in the example, it says that the liability are going down. So like the differences of the 2 million ringgit, it will be recognized as gain on the curtailment, and it will be recognized in the profit and loss statement and will be treated as the past service cost. So the reason why the pension scheme liability here is going down is because the employee that used to be part of the scheme, of the pensions liability scheme, are made redundant and they are gone. So that's why the pension, there is a reduction in the pensions scheme liability. So that's all for curtailments. Now I'm going to explain on termination benefits. So termination benefits are defined as employee benefits provided in exchange for the terminations of an employee as a result either an entity decisions to terminate an employee's employment before the normal retirement date, and second is an employee's decisions to accept an offer of benefits in exchange for the terminations of the employment. Means that when the company offer for terminations of the employee's employment, and when the company and when the employee decided to accept the offer. So termination benefit is actually considered as a separate category of employment benefits, because the event that gives rise to an obligation is the terminations of employment rather than employee service. Means that the employees get the benefits for their terminations of employment instead of the service that they render for the company. So terminations, moreover, terminations benefits are typically will be paid in a lump sum payment, and it also sometimes will include, first is enhancements of post-employee benefits, which will be paid either directly or indirectly through employee benefit plans. So enhancements of post-employment benefit is, for example, a company, they plan to close a department in 6 months and employee will lose their job, and let's say that some of the employee will need to stay until the end of the 6 months to finish their planned operations smoothly and gradually. So they are promised to pay they are promised a payment of bonus of 50,000 ringgit in return for their service until the end. So that's basically what the benefit is about, because because the company, they're paying the employees for them to stay until the terminations, not for actual leaving. And second is the salary until the end of specified notice period if the employees render no further service that provides economic benefit to the entity, means that the salary until when the employee render their service for the until the last time the employee render their service to the company. So what we conclude here is that some employee benefits, they are payable regardless of the reason of the employee's departure, and the payment of such benefit is certain, but the timing of the payment is uncertain. Okay, now the terminations benefit liability is recognized at the earlier of the following date, which is first, when the entity can no longer withdraw the offer of those benefits, and second, when the entity recognize cost for a restructuring under contingent liabilities and contingent asset, which involve the payments of terminations benefit. Now I'm going to explain more using this example given. So looking at the example given here, it says that as a result of a recent acquisitions, an entity plans to close one of its shopping outlets in 5 months, and at that time terminate the employment of all remaining outlet employees. However, the entity needs their expertise to complete backlogs. So first, each employee who stays and renders service until the closure of the entire outlet will receive a cash payments of 50,000 ringgit on the termination date. And second is, employees leaving before the closure of the outlet will receive 20,000 ringgit. And the last one is, there are 150 employees at the outlet. So, and at the time of announcing the plan, the entity expects 50 of them to leave before the closure. So as you can see here, the company, they will pay an amount of 20,000 ringgit to the employees, whether they will stay until the closure of the outlets to finish the backlogs, or if they choose to leave before the closure. So either way, they will be paid off 20,000 ringgit for the terminations benefits. So what the company needs to do is that they need to recognize the liability of 3 million ringgit, which is 150 staff times with 20,000 ringgit for the terminations benefit. So what they need to do is that they need to debit the termination expenses of 3 million ringgit, and they also need to credit the terminations liability of 3 million ringgit. And now the company expect that 100 of their staff will stay until the closure in order to complete the backlog. So those 100 staff, they will receive an amount of 50,000 ringgit each. So the balance of 30,000 ringgit is the incremental benefits, or as I explained earlier, it's like the enhancements of the post-employment benefits. So 30,000 ringgit is considered as bonus for them to stay until the end of the closure period. So what the company needs to do is that they need to account for those 3 million, which is 100 staff times with 30,000 ringgit, and they will get 3 million ringgit, and we will divide it by 5 months, which is the period until the closure. Hence, the company needs to pay for 600 ringgit each month. So we will debit the termination expenses of 30,000 ringgit, and we will debit the termination expenses of 600 ringgit, and we will also credit the terminations liability 600 ringgit. And the company needs to do this transaction until the last day of the 5th month. So that's all for the explanations on the example. So what we need to remember here is that termination benefits, they are different from the post-employment benefits, and the entity, which is the company, they can refuse to pay, or they can avoid to pay the employees if they did not offer them and does not terminate the employee's contract of employment. Means that if the company did not offer for terminations of the employments, the company, they are not obligated to pay the employees for their terminations benefits. So that's all for termination benefits and curtailments. So lastly is for the disclosure. So an entity, they shall disclose information that enables user of the financial information statements to evaluate the nature of its defined benefits plan and the financial effect of changes in those plans during the period, which is, these are the things that they need to disclose, which is first, the entity's accounting policy for recognizing actuarial gains and losses. Second is the general descriptions of the type of plan, and the third one is they also need to disclose on the reconciliations of assets and liability in the statements of financial positions, and they also need to disclose on the fair value of plan assets. Next is reconciliations of movements in liability, and the next one is breakdown of income statement expenses, actual returns on plan asset, and lastly they also need to disclose on the actual assumptions. So that's all from me. Thank you.
Alright, so we've learned about all of that, and what we need to know is, now we got exposure. We haven't worked yet, but now we have exposure on employee benefits. You can go to your job when the interviewer asks, why do you pick this job? You can answer, this company provides lucrative employee benefits. So have a nice day and see you again next time.